Silver is flashing stress right now, even when the screen price tries to look fine, and the real signal isn't ET in the headline candle, it's in the plumbing. Because there's a tug of war happening underneath the chart. The part of the market that needs metal is tightening its grip, and the part of the market that sells paper keeps pretending that's not a problem. And if you own silver or you're thinking about owning silver, the payoff in this video is simple and concrete. By the time we're done, you'll know the exact calendar window that can force the next violent move, the one metric that tells you whether pressure is building or fading, and the key price zones that matter over the next 1 to 2 weeks, plus what would actually invalidate the whole setup. And that's where the real pressure starts. Right now, the price context is already telling you this is not a normal market. Silver didn't just have a good year in 2025. It had a historic surge that pushed it to a record high around the low to mid 80s per ounce in December, and then immediately reminded everyone what happens when liquidity gets thin and leverage gets crowded. In early January 2026 alone, you can see how violent it has been. We have already seen prints in the low 70s and spikes back toward the low 80s within days, and spot has been hovering roughly in that mid to high 70s neighborhood as the market tries to decide whether it's cooling off or coiling up. But that's not the part that matters. The part that matters is volatility and structure. When a market can swing multiple dollars in a day, it's not just emotional, it's mechanical, it's margin, it's positioning, it's dealers hedging options. It is participants realizing that what looked like a deep pool is actually shallow when too many people reach for the same door at once. And if you think that's dramatic language, remember what happened at the end of December. Margin requirements on silver futures were raised, and the market responded with one of those air pocket drops that makes both bulls and bears feel like the floor is moving. That's not a conspiracy, that's incentives. When margin goes up, the weakest hands don't argue, they reduce risk. And when they reduce risk in a crowded trade, price doesn't glide, it jerks. Because if this one mechanism tightens again, the math changes. Here is the conflict you need to see clearly. The mainstream narrative loves to talk about silver like it as a single price on a screen, as if the silver market is one unified pool where any ounce can instantly become any other ounce. But in reality, silver is a network of locations, vault systems, refiners, bars that meet specific standards, delivery rules, and settlement habits. And when that network gets stressed, the outright price can lag the truth. The spread tells the truth. The cost of converting paper exposure into physical exposure tells the truth. The willingness of the market to deliver tells the truth. And right now, those are the places where stress likes to show up first. So let's talk about COMEX, because the title of this video is in T random. COMEX Stress is Rising is an ET about a meme. It's about the structure that sets price discovery for a massive portion of global trading. COMEX silver futures are standardized contracts. Each standard contract represents 5,000 troy ounces. Most traders never want a truck of silver. They roll, they close, they cash settle their P&L and move on. But the contract is physically settled by design, and that physical anchor is what keeps the paper market honest until it doesn't. And that's where the hidden detail lives. The underappreciated detail that reframes the entire story is this: inventory is high, can be truce at the same time. Deliverable supply is tight, is also true because not all inventory is actually for delivery, and not all silver is sitting where the market needs it when it needs it. There are categories and locations, and those two words, categories and locations, are where stress hides. On COMEX, people talk about registered and eligible stocks. Without turning this into a textbook, the simple version is eligible metal meets the specs, but it's not necessarily committed to be delivered. Registered metal is tagged and available for delivery against futures. That difference sounds boring until you realize what it means in a stress moment. You can have a big warehouse total that looks comforting and still have a deliverable pool that is relatively tight because the metal owners have no incentive to make it available at today's price, or they're waiting, or it's pledged, or it's simply not moving. And when participants sense that convertibility, paper to metal, might get harder, behavior changes fast. But that's still not the whole story. The bigger, nastier twist is location. The global benchmark for large-scale physical silver trading is heavily tied to London's OTC market and its vault ecosystem. COMEX is New York. London is London. Sounds obvious. But here's the thing. When silver flows get pulled into one region because of tariff fears, policy uncertainty, financing incentives, or just who has the best bid for bars at that moment, you don't get one global price anymore. You get regional tightness, you get thinner liquidity where the benchmark gets set, you get a market that becomes more sensitive to marginal demand. And that is exactly the pattern major institutions have been warning about. Not a global shortage of silver in the abstract, but silver being stuck in the wrong places, which makes the system prone to squeezes and sudden reversals when tightness eases. And that's where the real pressure starts, because a squeeze system doesn't move like a normal market. It snaps. Now, let's translate that into something you can actually watch without needing a terminal. When a market is stressed, it doesn't always scream in the outright price first. It whispers in structure. Think of the outright price as the headline and structure as the footnotes that actually contain the truth. The term structure, how near-month futures are priced versus later months, can reveal urgency. When the front of the curve gets bid relative to the back, that's the market saying, I value immediacy. It's not always pure backwardation versus contango in a neat textbook sense, because funding costs, convenience yields, and inventory financing all play roles. But the intuition holds. If the market starts paying up for the front end, something is tightening. And if that front end tightness comes with rising implied volatility and weird behavior around delivery windows, you're not watching random traders, you're watching constraints. And the next detail is what flips the whole setup. Those constraints get amplified by the calendar. Right now, the calendar is a loaded spring. The final week of January is not just another week. It's a collision point where multiple forces that normally stay hidden are forced to make choices. For example, February silver options on COMEX have a last trading day on January 27th, 2026. That matters because options are not just side bets, they're engines. Dealers who are short options hedge dynamically. If price is moving quickly around key strikes, hedging can turn into forced buying or forced selling. And that feedback loop can shove price through levels faster than fundamentals would ever justify in a calm environment. Then you've got the January futures contract itself approaching its last trading day around January 28th, 2026 by common exchange conventions and published expirations calendars. That ES, when paper positions that Don T want delivery, have to get out of the way. And if a lot of participants try to roll or exit at the same time, liquidity thins and spreads can widen. Layer month end onto that, when funds rebalance, risk books get tightened, and liquidity providers, Don T, always want to warehouse risk overnight. And you have a perfect environment for stress to express itself. Because if this one level breaks, the math changes. Now I'm going to stack proof here, because one argument never earns trust in a market like silver. Proof stack number one is institutional framing. When serious desks say this market is more sensitive now, they're not trying to entertain you. They're telling you marginal flows will move price more than you expect, up and down. That means you should stop thinking in straight lines. Proof stack number two is the simple reality of volatility. CME's own volatility measures for silver have been printing at levels that scream risk is not priced like a sleepy commodity. High implied volatility means the options market is charging a premium for uncertainty. And that uncertainty is often tied to structural concerns, where bars are, how easily they can be mobilized, and how participants behave around delivery and policy risk. Proof stack number three is the on-the-ground evidence that a huge amount of investable silver is already warehoused in financial vehicles. The iShares Silver Trust, SLV, holds on the order of hundreds of millions of ounces of physical silver, and recent reporting has pegged it around the 500 million ounce area, worth tens of billions of dollars at current prices. That is not a sideshow. That is a massive chunk of accessible bullion. Why does that matter? Because ETF demand is a transmission mechanism between investor behavior and physical sourcing. When ETF shares trade rich and creations happen, authorized participants have to source bars. When ETF shares trade cheap and redemptions happen, bars can come out. In a calm, integrated market, that process helps smooth price. In a fragmented, location-stressed market, it can do the opposite. It can pull metal toward the region where it demanded and away from the region where the benchmark liquidity sits, worsening tightness. And that's where the real pressure starts. Proof stack number four is London's vault ecosystem itself. London has held tens of thousands of tons of silver in its vault system in recent snapshots, and those inventories matter because London is where a huge portion of the institutional physical market transacts. If those inventories get unusually thin relative to activity, the benchmark becomes more fragile. You can still print a spot price, sure, but the depth behind that price changes. The market becomes less forgiving. Small net flows can cause outsized moves. Proof stack number five is the supply chain backdrop. Silver isn't just a precious metal. It's a critical industrial input. The demand side is not only jewelry and coins, it's electronics, photovoltaics, electrification, and a long list of modern supply chain uses where silver AS conductivity is not easily substituted at scale without trade-offs. And on the supply side, silver is often a byproduct of mining other metals. Lead, zinc, copper. That means supply doesn't respond to silver price the way a pure play commodity might. Higher price doesn't instantly create new mines. Mines have permitting cycles, capital cycles, and geology. Refining and assaying capacity has lead times. Recycling helps, but it has limits and timing issues too. So when demand accelerates, while supply can't snap to attention, The market lives on inventories and flow. And when flows get pinned by location and policy frictions, stress rises. But that's not the part that matters. The part that matters is what this forces participants to do this week. Because markets move when someone is forced, not when someone has an opinion. Forced buying is different from bullishness. Forced selling is different from bearishness. And silver is the kind of market where forced behavior shows up quickly. Because it's smaller than gold, it's more volatile, and it has fewer anchors. Gold has central bank demand that often provides a psychological backstop. Silver doesn't have the same structural bid. That makes silver more reflexive, more sensitive to flows, more prone to overshoot, more prone to snap back. So let's walk through the forced buyer pathway in plain terms. Imagine you are short silver futures. Maybe you're hedging. Maybe you're speculating. Maybe you're doing a relative value trade. If the front-end tightness rises and the market starts behaving like deliverability is getting more expensive, you have choices. You can buy back the short, cover. You can roll the short to a later month, pay the spread. Or you can stand and deliver, meaning you better have access to the right kind of metal in the right place within the rules. In calm markets, rolling is cheap and easy. In stressed markets, rolling can be punitive. Spreads can widen, liquidity can thin, and if your position is leveraged, margin becomes your boss. A margin hike or a volatility spike can turn "I am fine" into "I need to reduce exposure today." That's how you get air pockets and vertical candles. And that's where the real pressure starts, because once the market smells forced, participants, it pushes, it probes, it runs stops. It forces the next layer of risk managers to act. Now add options on top of that. If the options market is loaded with open interest around certain strikes, especially near round numbers, dealer hedging can add fuel. When price rises towards strikes where dealers are short gamma, they may have to buy as price rises and sell as price falls, which amplifies the move. In the final week of January, that effect can be louder because the clock is ticking. Options expire, futures roll. Delivery risk gets more immediate, liquidity providers get cautious, and a weekend gap can make the whole thing nastier because the market can move while you can't. That's why the calendar matters. That's why right now matters. Because the market isn't just deciding what silver is worth. The market is deciding how much it costs to be wrong at the worst possible time. But that's not the part that matters. There was another calendar trigger that deserves your attention because it can create a false move that shakes people out right before the real move. In early to mid-January, commodity indices often rebalance. And this year, there has been notable chatter that the Bloomberg Commodity Index rebalancing window, roughly January 8th through January 14th, can create mechanical selling in components that have become large weights after big rallies. Silver, after its massive 2025 move, is one of the places where that rebalance pressure can show up. What does that mean for you? It means you could see selling that has nothing to do with the silver story changing. It could be purely mechanical. It could be forced. It could push price down into support even while the underlying structural tightness remains. And that's where the real pressure starts, because the market loves to weaponize that kind of move. It drops the price, headlines scream silver crashes, everyone who didn't have a plan panics, and then, if the structural stress is still there, the market snaps back and leaves them behind. So you need a psychology shield, and we're going to build it. But first, let's address the biggest counterargument, because if you can't handle the counterargument, you can't handle this trade or this investment with a straight face. The counterargument is simple. COMEX inventories are huge. Therefore, stress is fake. And it sounds compelling because it's intuitive. More inventory equals less scarcity, but it's incomplete. Remember the hidden detail. Categories and locations. Total inventory doesn't tell you what is actually deliverable without friction. Total inventory doesn't tell you what owners are willing to part with at current prices. Total inventory doesn't, tell you whether the benchmark liquidity center, often tied to London or OTC ecosystem, has enough float to absorb marginal demand without disorderly moves. And total inventory doesn't tell you what happens when policy uncertainty pulls metal into one region and strands it there. A market can be well supplied globally and still be locally tight where price is discovered. That's not theoretical. That's how real commodity markets break. And silver is particularly vulnerable because it financialized enough for paper leverage to dominate short-term price discovery, but physical enough that at the wrong moment, the paper has to answer to the bar. And that's where the real pressure starts. Now, I'm not here to sell you a fantasy. Tightness can ease, metal can move back, policy fears can cool. If silver flows back toward London, or if the market finds a way to mobilize inventory efficiently, spreads can relax and price can correct hard. Institutions have explicitly warned that silver can experience extreme swings in both directions. And you've already seen it. So your plan cannot be, I'm right, therefore I win. Your plan has to be, I understand the mechanism, I know what confirms it, and I know what invalidates it. Because if you don't, volatility will use you, and silver volatility doesn't just test conviction, it hunts it. Here's how volatility manipulates retail investors, and I want you to recognize it in real time. First, it compresses time. It makes you feel like you must act now, even when acting now is the worst choice. Second, it hijacks narrative. On up days, the story becomes destiny. On down days, the story becomes doom. Third, it punishes leverage. Even if you're directionally correct, leverage can force you out at the worst moment through margin calls or emotional capitulation. And fourth, it uses fake confirmation. A sharp pullback after a rally makes people believe the move is over, even when it's just the market resetting positioning and liquidity. You protect yourself by separating trend signal from noise. Trend signal is structure. Trend signal is whether the market keeps defending higher lows, whether front-end tightness persists, whether the term structure stays stressed, whether inventories and locations keep telling the same story. Noise is a violent day that happens because an exchange changed margin, an index rebalanced, or liquidity disappeared for a few hours. And that's not the part that matters. What matters is what happens after the noise. Does the market rebound quickly, suggesting real demand underneath? Or does it break structure and fail to reclaim key levels, suggesting stress is easing and speculative froth is unwinding? That's how you stay rational. Now let's make this practical. Over the next 1 to 2 weeks, there are 2 clean scenarios you should keep in your head at all times. Scenario 1 is the controlled pullback and retest. In this scenario, silver sells off, maybe because of index rebalancing flows, maybe because of profit taking, maybe because liquidity thins and weak hands get shaken. Price comes down into a support zone. Think roughly the low to mid 70s, potentially even probing around the low 70s where we've already seen prints early this month. And then it stabilizes. The key is what it does after stabilization. If it bounces, retests, and holds, meaning it doesn't just spike up once, but it builds a base, then you're likely watching a market that is digesting, not collapsing. In that scenario, the stress thesis stays alive. The market is basically saying, we can't stay cheap for long because real buying shows up. And that's where the real pressure starts, because controlled pullbacks are how markets reset fuel for continuation. Scenario 2 is the continuation squeeze. In this scenario, silver doesn't give you the polite dip. It grinds higher, then pops, then gaps. It takes out resistance zones, think the upper 70s into the low 80s, and it challenges that recent record high region from December. If price starts pressing into the low to mid 80s again, you have to respect the possibility that it's not just momentum, it's mechanics. It could be spread tightness, short covering, dealer hedging, and calendar-driven repositioning colliding. In that scenario, the risk isn't missing a dip. The risk is being on the wrong side of a market that can move multiple dollars while you re-blinking. And yes, that cuts both ways. A squeeze can reverse violently. That's why you never confuse scenario 2 with guaranteed moon. But you also don't dismiss it as hype when the structure supports it, because if this one level breaks, the math changes. Now let ES talk about levels without pretending we can draw a perfect line through a chaotic market. I'm not going to give you fake precision. Silver doesn't respect fake precision, but it does respect zones and it respects psychology. Right now, one obvious psychological anchor is the mid-70s area, because that S, roughly where spot has been hovering and where a lot of participants will mentally frame value after the 2025 surge. Below that, the low 70s zone, call it roughly $71 to $73, has already been tested in early January data, and markets remember those areas. If silver breaks into that zone and cannot reclaim it, especially if it fails multiple times, that would be a warning sign that the market is not just shaking out, it's shifting. On the upside, the upper 70s into the $80 area is the door. If silver can reclaim and hold above roughly $78 to $80 and keep building above it, the next magnet is the recent high zone in the low to mid 80s. And if the market starts trading like that zone is not a ceiling but a hallway, you have to be ready for the kind of volatility where daily ranges feel surreal. But that's not the part that matters. The part that matters is confirmation. Confirmation is not price went up today. Confirmation is the plumbing behaving like stress persists. So what do you watch? You watch the front month versus back month relationship. You watch whether the market is paying up for immediacy. You watch whether spreads stay elevated or tighten. You watch whether the market reacts disproportionately to marginal demand, because that tells you depth is thin. You watch whether ETF holdings are rising or stabilizing when price dips, which can suggest investors are using weakness to add rather than flee. You watch whether news about inventories is actually about deliverable supply and location rather than just totals. And you watch the calendar like it's a countdown clock, because it is. Here's the near-term roadmap. From now through the middle of January, be aware of index rebalancing flows that can create mechanical selling pressure. Don't let that alone convince you the story is dead. Watch how silver behaves after those flows. Does it stabilize quickly? Does it bounce with authority? Or does it melt down and fail to recover? Then you move toward the final week of January. February options have their last trade date on January 27. That's when gamma can flip personalities. That's when dealers can shift from dampening moves to amplifying them depending on positioning. Then, around January 28, the January futures contract hits its last trade day region. That's when those who don't want delivery are forced to act. And month end adds another layer of risk management behavior. Put those together, and you get a window where stress can express itself sharply. And that's where the real pressure starts. Now, let's ground this in the physical versus paper tension, because it's easy to talk about paper like it as fake and physical like it as pure. That's not helpful. Paper markets exist for a reason. Hedging, liquidity, price discovery. Physical markets exist for a reason. Real-world use, real-world settlement. The tension arises when the paper market S leverage grows faster than the physical market S ability or willingness to mobilize supply at the prices being implied. In a healthy market, arbitrage keeps everything stitched together. If New York is tight, metal flows. If London is tight, metal flows. If Shanghai is tight, flows adjust. But arbitrage is not magic. Arbitrage requires transport, financing, trusted bars, and regulatory certainty. Add friction, tariff fears, licensing requirements, policy uncertainty, financing constraints, and arbitrage slows. When arbitrage slows, the market fragments. When the market fragments, spreads become more informative than spot. And that's why this title matters. COMEX stress rising means the conversion between paper exposure and deliverable metal is becoming a focal point. It means people who normally treat futures as a clean financial instrument are being forced to think about where the bars are and what it costs to move them. It means liquidity is not as deep as the headline price suggests. And that's where the real pressure starts. There's also a macro layer, because silver doesn't trade in a vacuum. In 2025, the macro cocktail included expectations for monetary easing, currency weakness, and the kind of uncertainty that makes investors want hard assets. Silver benefits from that, but it also suffers from its own personality. It's a high beta metal. It can outperform on the way up and underperform on the way down. So you need a two-lens view. Lens one, macro tailwinds. If real rates fall, if currencies wobble, if risk hedging demand rises, silver can get pulled higher alongside gold and beyond it. Lens two, liquidity and risk appetite. If the market hits a risk-off wave, silver can get hit hard as funds delever and reduce exposure. That's why you never bet your life on a straight line. You build your plan around scenarios, confirmations, and invalidations. And now we need to talk about invalidation honestly. What would weaken this thesis that stress is rising? 1. If the term structure relaxes, if the front end stops acting urgent, if spreads normalize, if implied volatility collapses. 2. If policy uncertainty clears and metal starts flowing back toward the benchmark liquidity centers, easing localized tightness. 3. If price breaks key support zones and fails to reclaim them, not for hours but for days, suggesting real demand is not stepping in. 4. If ETF holdings start bleeding persistently during dips, implying investors are distributing rather than accumulating. None of those guarantee bear market forever, but they would tell you the stress narrative is cooling. And if you're honest, you want that information because it keeps you from becoming a bag holder with a story. But that's not the part that matters. The part that matters is what you do with the information. If you own physical silver, your time horizon is different. You care about long-run purchasing power, supply deficits, industrial demand, and the role of hard assets in a world where financial systems are always one policy decision away from a regime change. If you own silver exposure through ETFs or miners, you care about liquidity, premiums, and volatility. If you trade futures or options, you care about margin, spreads, gamma, and survival. The market can be bullish long-term and still savage you short-term if you don't respect volatility. So here's the psychology shield, delivered bluntly. The market will try to make you act at the wrong time by amplifying pain and urgency. When silver drops $5 in a day, it will feel like the story ended. When silver rips $5 in a day, it will feel like you must chase. Both feelings are traps. Your job is to define what matters before the move happens. Decide what you consider trend signal. Decide what you consider noise. Decide what your risk is. And then let the market do what it does without yanking you around emotionally. That's how you build trust with yourself. And that's the only kind of trust that survives silver. Now let's pull everything into a tight checklist you can use immediately, because we promised payoff. Over the next week or two, watch the calendar. The January 8 to 14 window for potential index rebalance flows, the January 27 options cutoff for February silver options, the January 28th last trade window for the January futures contract, and the month-end risk management behavior. Watch price zones, the low 70s, support area where weakness becomes meaningful if it fails to recover, the mid-70s as a pivot, the upper 70s into $80 as the door, and the low to mid-80s as the pressure point where squeezes can become self-reinforcing. Watch structure. Does the front of the curve stay bid relative to the back? Do spreads act tight? Does volatility stay elevated? Watch the physical proxies, ETF holdings behavior during dips, and any credible signals about inventories and where metal is actually sitting. And most importantly, watch the metric that people ignore when they only stare at spot, the spread behavior around the delivery and expiry window. Because the spread is where the market confesses what it's afraid of. And that's where the real pressure starts. If you want one mental image to carry with you, it's this. Silver is not one pool of water. It's a set of connected tanks with valves. When the valves are open, pressure equalizes and price is smoother. When the valves tighten because of location, policy, financing, or fear, pressure builds in one tank. The gauge on the outside might look stable for a moment, but the pressure is real, and when it releases fast. That's why you're seeing extreme swings language from institutions. That's why margin hikes matter so much. That's why index rebalancing flows can be the shakeout before the move. That's why late January is not just another date on the calendar. And that's why if you own silver, you should pay attention. Not because you need to panic, but because you need to be prepared. A prepared investor isn't the one who predicts every tick. A prepared investor is the one who knows what they're watching, knows what would change their mind, and knows how volatility will try to manipulate them into making a bad decision. And here's the subtle CTA, because I'm not going to beg you for it. If you want updates that stay focused on mechanics, structure, and what to watch next, rather than hype, stay close. This is a market where the crowd gets loud at the wrong moments. The edge is being calm when the tape is violent. The edge is reading the plumbing while others argue about the headline. And the final revelation, the one metric you must watch, is whether the front-end stress remains persistent into that late January window. If the spreads and term structure keep signaling urgency while price holds key support, the pressure is still in the system. If the structure relaxes and price can't reclaim pivots, the system is decompressing. That's the difference between a controlled retest and a continuation squeeze. That's the difference between noise and trend. That's the difference between being shaken out and being positioned.